3.1 million ounces didn't move. It fled. And the market is pretending that's normal. That's the first tell. The second tell is the pushback you're going to hear immediately, that nothing happened, that inventories are huge, that this is just logistics, that you should stop looking at the plumbing and focus on the headline price. And that's exactly why you need to look at the plumbing, because when a market gets tight, price is often the last thing to confess. The spread confesses first, the delivery behavior confesses first, the quiet withdrawal confesses first. And if you stay with me to the end, I'm going to give you the only checklist that matters for the next week, levels. Triggers what confirms this, what breaks it, and the one detail that turns bank run from a metaphor into math. Because if this is what it looks like, you don't want to be late to the realization, and you definitely don't want to get shaken out by the volatility designed to make you doubt your own eyes. Let's start with the part most people miss on purpose because it's inconvenient. A classic bank run isn't about the total money in the system. It's about the money you can withdraw right now. That's the entire difference between a calm headline and a panicked crowd. If the system says, don't worry, we have plenty, but the ATM says, try again later. The crowd doesn't care about the total number on a balance sheet. The crowd cares about access. That's how physical markets work too. You can quote the biggest inventory number you want. You can point to total stocks and wave it around like a security blanket. But when a chunk the size of 1 million ounces evaporates overnight from the place the world watches for deliverable credibility, it changes behavior. And behavior is the lead indicator. Price is the lagging headline. Now, I'm not asking you to believe in cartoon villains. I'm asking you to understand incentives. The people who live inside these markets, dealers, refiners, manufacturers, funds, and yes, the banks that intermediate it, don't need to conspire to create pressure. Pressure happens automatically when the system gets thin. When deliverable supply is plentiful, everyone is relaxed. They roll paper, they sell calls, they short into strength, they arbitrage the curve, they treat silver like an endless ocean. But when deliverable supply starts shrinking in noticeable bursts, the entire ecosystem tightens its grip. They pull offers, they demand better terms, they hoard optionality, they start paying up for certainty, and that's where the real pressure starts. Here's the street-level symptom that tells you this is indeed just a spreadsheet game. When a market gets tight, the first thing that breaks isn't price. It's convenience. You start seeing available turn into available in 2 weeks. You start seeing tight turn into allocation. You see small premium jumps that look meaningless until you realize they re-happening while price is supposedly calm. You see rumors of big buyers wanting specific forms of metal, and suddenly the same metal that was plentiful becomes hard to source quickly. That's what tightness looks like. Not fireworks, not a guaranteed moonshot. Tightness looks like friction. It looks like time. It looks like the removal of choice. And people who only stare at a candle chart miss it because it doesn't show up as a dramatic line until the moment it does, and then everyone claims it was obvious. But it wasn't obvious. It was encoded in behavior. And the next detail is what flips the whole setup. 3.1 million ounces is not a rounding error. In COMEX terms, silver trades in 5,000-ounce contracts. Do the rough math. 3.1 million divided by 5,000 is about 620 contracts worth of metal. That's not a truck. That's not a clerical adjustment. Well, that's enough size that if it's in the wrong category at the wrong time, it changes the cushion against delivery claims. And here, that's the hidden detail. The market doesn't run on how much silver exists. It runs on how much silver can be delivered on demand, under the rules and the form required, within the window that matters. This is where people get hypnotized by the wrong number. They see eligible and think deliverable. They see inventory and think supply. But those words are not the same thing. And if you treat them like they are, the market will educate you violently. So let's make this simple without dumbing it down. Inside the COMEX warehouse system, metal is often categorized in ways that matter for delivery mechanics. You'll hear terms like registered and eligible. The clean analogy is this. Registered is cash in the ATM. Eligible is money in the vault. Eligible metal meets certain criteria and is stored in approved vaults, but it is not necessarily sitting there with its deliver me against futures paperwork already attached. Registered metal is the pile that is actually set up, warranted ready to be used to settle delivery. And the reason this matters is psychological and mechanical at the same time. If you see registered metal shrinking, you're watching the ATM run low. You might still have money in the vault, but someone has to choose to move it into the ATM. Someone has to decide to make it deliverable. And in a calm market, that happens smoothly. In a stressed market, people don't volunteer their metal into the delivery pile, unless the price is good enough, the incentives are strong enough, or the risk of not doing it is greater than the risk of doing it. That's not conspiracy. That's rational self-preservation. And that's why a transfer can still be a signal. because the transfer itself reveals preference under pressure. Now zoom out and look at timing. Why now? Why does a big overnight draw matter this week instead of being shrugged off as a curiosity? Because the calendar is the catalyst, and the calendar is what forces participants to reveal their hand. Early January is not just a new year, it's a regime reset. Funds rebalance. Desks reopen full risk budgets. Hedgers revisit coverage. Physical buyers look at budgets and procurement cycles. And liquidity, especially in the kind of paper that sets the marginal price, can be thinner than people admit, because positioning is transitioning from year-end constraints to new year expression. That combination is dangerous. New conviction, shifting hedges, and thinner liquidity means price can gap on things that would have been absorbed a month earlier. And if there's a delivery-related motivation, if participants are thinking about delivery windows, roll behavior, and the relative value between months, then inventory changes stop being trivia and start being fuel. Because if this one level breaks, the math changes. Let's talk about the tape, because it employs already behaving like a market that can decide whether it mess calm or stressed. Silver recently has not been a sleepy asset. It has been snapping and whipping, moving in a range that, depending on the day and venue you watch, has looked like it as bouncing in the low to mid 70s and pushing up into the high 70s to low 80s. That's not a slow drift. That's a market where liquidity thins and then returns and then thins again. That's a market where stops matter, where options matter, where dealer hedging matters. It's also a market where people who are late chase and people who are early get punished by wicks, and that's exactly the emotional environment that creates a bank run feel without the market ever having to declare anything dramatic. Because the stress expresses itself as discontinuity, and that discontinuity is the environment where the spread tells the truth. Here's how the spread tells the truth in plain language. In normal times, the futures curve, the pricing of different delivery months reflects storage costs, financing costs, and convenience. When metal is abundant and financing is the story, you tend to see contango. Later months priced higher than near months because carrying inventory costs money. When metal is tight and immediate availability is prized, you can see backwardation pressure. Near months rich relative to later months because the market is willing to pay for now. Even when the curve doesn't show textbook backwardation, you can see stress in relative spreads, and how quickly the front month reacts, and how offers disappear, and how roll costs behave. And this is the part most people never learn because it isn't as sexy as a chart screenshot. Market structure is where truth leaks out before headlines catch up. But that's not the part that matters most. The part that matters most is what market structure forces participants to do. When the front end tightens, shorts and hedgers face a choice. If you are short futures, you either roll your short forward, or you deliver, or you cover. Rolling isn't free. Rolling depends on liquidity and spreads. Delivering depends on access to deliverable metal and the economics of putting it into registered form. Covering depends on price and risk appetite. In a calm market, the system glides. In a stressed market, each option becomes more expensive in some dimension: price, spread, margin, or operational constraint. That creates reflexivity. The very act of trying to manage risk moves the market. And reflexivity is how a market goes from it is fine to why is it moving like this in a matter of days, sometimes hours. And that's where the real pressure starts. Now layer in the macro backdrop without getting lost in it. Gold has been acting like a macro microphone, volatile, sensitive to rates and risk, responsive to geopolitics, and often moving in a way that suggests the market is not fully convinced the world is stable. Silver is not just gold's little brother. It has industrial demand, it has a different physical ecosystem, it has different inventory dynamics, and it has a different options profile. But silver tends to amplify regimes. When the world gets more uncertain, when currency stress rises, when real rates and inflation expectations pull in different directions, when risk hedging becomes fashionable again, silver can become the crowded theater. People rush in for upside, then volatility punishes them, then they rush back out. Meanwhile, physical flows and procurement don't stop on a dime. That mismatch between paper mood swings and physical reality is where the bank run analogy becomes useful. Paper can say, relax, but physical can quietly say, secure it. And that divergence is the hidden mechanism the mainstream misses because it's easier to talk about a headline than about an incentive. So let's stack proof like a professional because you never hang a thesis on one nail. First proof, the inventory event itself, an overnight draw of roughly 1 million ounces, is a real footprint. Second proof, the tape and volatility. Silver has been swinging, not sleeping, consistent with thin liquidity and crowded positioning. Third proof, macro regime uncertainty. Gold index behavior and broader risk signals make it more likely investors are seeking hard asset optionality. Fourth proof, the structure mechanics, Registered versus eligible matters because deliverability is the choke point, not theoretical abundance. Fifth proof, behavioral response. When market participants see deliverable supply thin, they change what they're willing to sell, when, and at what spread. And the sixth proof, because you always want one more, is the global angle. Silver is not a closed pool, it's a network. When price and availability diverge region to region, arbitrage wakes up. And arbitrage is not charity. Arbitrage is gravity. Here's what global arbitrage means in the real world. If the price signal in one region says silver is cheap relative to another, after adjusting for currency, freight, refining, and timing, metal tends to flow toward the higher value use. But the flows are not instant. Refining has lead times. Logistics have constraints. Different forms of metal are not perfectly interchangeable without cost. And when those frictions matter, the marginal unit becomes expensive. So even if there is silver, the question becomes, is there the right silver in the right form, in the right place, on the right schedule? That SY a market can have big inventory numbers and still feel tight at the front end. That's why a draw can matter even if it is partially offset later. Because tightness is about the marginal unit. And the marginal unit is where price discovery lives. The next detail is what flips the whole setup, what happens after pullbacks. This is where skeptics deserve respect, because skepticism is how you avoid getting hypnotized by drama. There are clean explanations for inventory changes that don't imply systemic stress. Metal can be moved between facilities. Metal can be reclassified. Reporting can have lags. Eligible can be converted to registered if incentives are right. A big number can print in one day and then partially reverse. And yes, it is entirely possible that this 1 million ounce event is an operational move that becomes a footnote. That's the honest counterpoint. But here's the rebuttal mechanics. Even if it's just a transfer, the transfer still reveals something because transfers happen for reasons. Reasons like risk preference, reasons like delivery planning, reasons like someone wanting metal out of the system that makes it easy to claim. And when the crowd is calm, people don't usually pay the friction cost of moving or reclassifying unless they have an incentive. Incentives are information. And that's why you don't argue about motives. You watch what the system forces people to do next. Because if the move is meaningless, behavior normalizes. If the move is meaningful, behavior tightens. And that's where the real pressure starts. Now let AS address the trap that will hit you hardest if you break it. For right, volatility weaponizes your emotions. The market does not need to beat you on direction. It only needs to beat you on timing. It needs you to buy the top of a spike, then sell the bottom of a shakeout, then watch price drift back up without you. That's how capital transfers from impatient hands to patient hands. And in metals, it happens with a particular cruelty because the narratives swing faster than the physical reality. One day it's industrial demand collapse, the next day it's shortage. And one day it's rates up, metals down. The next day it's currency stress, metals up. And if you let headlines drive your risk management, you become liquidity for someone else. So here's your psychology shield. Separate trend signals from noise. Trend signals are structural. Inventory behavior, curve behavior, repeated defense of key levels, consistent physical tightness indicators, institutional flows that persist. Noise is the wick, the rumor, the one-day panic, the algorithmic hunt for stops. If you can't tell the difference in the moment, you default to process, not prediction. And that's not the part that matters. It asks what that process does to your decision-making when things get violent. Because remember this, price can whip around violently even if the thesis is correct. In fact, the more correct the thesis, the more violent the attempts to shake you out, because crowded positioning creates forced flows. When price jumps, shorts cover, dealers hedge, momentum chases. When price drops, leveraged longs puke, funds rebalance, options dealers unwind, and the same market that felt like a rocket suddenly feels like a trapdoor. That's not proof you were wrong. That's proof the market is two-sided and reflexive. Your job is not to predict every tick. Your job is to know what you're watching, what would confirm it, and what would invalidate it. And that S, where the real pressure starts, when you realize you might, we're not trading price, you're trading behavior. So let S put this into a clean two-scenario lens so we don't a T lie to ourselves. Scenario 1 is the controlled pullback and retest. In this scenario, silver pulls back toward a key support zone. Think the mid to upper 70s area as a first battleground, with deeper support closer to the low 70s if the shakeout gets mean, then stabilizes. You see buyers defend. You see the curve and spreads not collapse. You see inventory behavior not suddenly flood back into registered in a way that screams no stress. You get a retest, a pause, and then continuation attempts. This is the scenario that feels boring in hindsight, but emotionally brutal in real time, because it makes you question everything while doing almost nothing. Scenario 2 is the continuation squeeze and gap risk. In this scenario, price doesn't give you a clean retest. Liquidity thins. A key resistance, often in the high 70s into the low 80s neighborhood, gets clipped and the market accelerates. That acceleration forces hedging. It forces covering. It forces people who are waiting for a better entry to chase. And because liquidity can be thin, it can gap through levels that everyone thought were strong. This scenario is exciting, and it's also dangerous because it punishes late leverage. The point isn't to predict which scenario wins. The point is to know what confirms each, so you stop making emotional decisions disguised as analysis. Because if this one level breaks, the math changes. Now, let ES bring the bank run concept into the exact place it matters: claims versus cushion. Futures markets can create a large amount of paper exposure relative to the immediately deliverable physical. That's not automatically evil. That's how hedging and price discovery function. But it creates sensitivity. If too many participants suddenly prefer physical certainty over paper exposure, if they decide they want metal they can control rather than an instrument they can roll, then the cushion matters. And the cushion is not all silver on earth. It is the deliverable pile and the willingness of holders of eligible metal to make it registered. When the system is relaxed, the cushion feels large. When confidence slips, the cushion feels small, even if the total number is big. And a large overnight draw is a confidence event, not because it proves catastrophe, because it triggers questions. Who moved it? Why now? Will more follow? Will it be replaced? Will spreads react? Will the front end tighten? Will the market pay up for immediacy? Those questions alone change behavior. And behavior is fuel. That's where the real pressure starts. So what do you watch next, specifically, in the next week or two, to separate drama from signal? First, watch whether silver holds the nearest support band after any pullback. If price slices through the mid to upper 70s and can't recover, that's a warning that the market is still deleveraging and that the shakeout can deepen. If it probes and reclaims quickly, that's a sign the bid is real. Second, watch whether the market can reclaim and hold above the high 70s into the low 80s zone without instantly being slapped down. If it can hold above resistance, that's when squeezes become self-feeding, because option hedging and short risk management become compulsory rather than optional. Third, watch the behavior around the curve and near-term spreads. You don't need to be an expert in term structure to see stress. Stress looks like the front end refusing to cheapen even on pullbacks, or spreads snapping back quickly after dips. Fourth, watch the warehouse behavior. Do you see continued net draws, especially in deliverable categories, or do you see a sudden and sustained replenishment that suggests the system is relaxed? Fifth, watch the street symptom layer. Do premiums and lead times calm down, or do they stay sticky? Are retail and industrial buyers acting like there's no urgency, or are they quietly securing supply? One of these stories is consistent with a footnote. The other is consistent with a developing run, and that's where the real pressure starts. Now, let's talk targets and invalidation without pretending we can see the future with precision. Targets are not promises. Targets are levels where behavior changes. In a tightening environment, the first target is always the prior resistance zone that forced sellers to appear last time. Again, high 70s into low 80s. If price can establish acceptance above that band, the market often seeks the next liquidity pocket higher, because stop orders and hedging flows cluster above obvious highs. If it fails repeatedly and starts making lower highs, that's where momentum funds lose interest and the market becomes vulnerable to a deeper reset. Invalidation is even more important. For this bank run framing to matter, you need to see ongoing signs that deliverable tightness is not simply being smoothed away. A clean invalidation is not a red day. A clean invalidation is a combination. Inventory pressure dissipates, spreads soften, the front end stops behaving like it's paying for immediacy, and price breaks key supports and stays there. In other words, the system stops acting like it's under stress. If that happens, you respect it. You don't argue with it, because your job is to trade the evidence, not your ego. But that's not the part that matters most. What matters most is how you act when the market tries to humiliate you with noise. Because here's how volatility will try to manipulate you, and you can take this to the bank. First, it will rally hard enough to make you feel late. Then it will drop hard enough to make you feel stupid. Then it will go sideways until you feel bored. Then it will move again the moment you look away. It will produce one terrifying headline at the exact moment your emotions are already fragile. It will make you question the mast and bank run narrative on the day it wants you to sell. And it will make you believe the silver is unstoppable narrative on the day it wants you to buy. That's not a conspiracy. That mess simply how a liquid market transfers risk. It finds the maximum point of discomfort and presses on it. Your defense is structure. Your defense is scenarios. Your defense is sizing. Your defense is knowing that being early feels the same as being wrong until it doesn't. And if you can't tolerate that psychological experience, you don't need a new indicator. You need a smaller position. Because if this one level breaks, the math changes, and you need to be alive to respond, not emotionally maxed out. Now, let yes connect one more dot that metals people understand in their bones. Paper and physical can diverge because they serve different masters. Paper serves liquidity and leverage. Physical serves certainty and use. When financial conditions change, when funding costs, risk appetite, and volatility change, paper can swing wildly. Physical demand doesn't swing as fast because factories don't turn off overnight and procurement doesn't behave like day trading. That is why in stress regimes, you can see paper sell-offs that don't fully relieve physical tightness. It's also why you can see paper rallies that outrun physical reality temporarily, then snap back. The truth is in the interaction. Does physical behavior confirm the paper move, or is paper just running on reflex and then stalling? The overnight inventory event is a physical behavior data point, not the only one, but a meaningful one. It says someone cared enough to remove a large chunk from a visible pool. And whether that evolves into a bigger story depends on what happens next in the same places that delivered the first signal. Inventories, spreads, and behavior after pullbacks. So here's your next week checklist, tight and actionable, the kind of thing you can actually use. 1. On any dip, watch if silver finds a bid and reclaims the nearest support band quickly rather than bleeding slowly. Quick reclaim suggests strong hands. Slow bleed suggests de-risking is still in control. 2. Watch whether the market can break and hold above the high 70s into the low 80 zone. Acceptance above is where continuation squeezes live. Rejection below is where chop and shakeouts breed. 3. Watch for the front-end truth in structure. Does immediacy stay valued, or does the curve soften as if supply is comfortably available? 4. Watch the warehouse narrative with discipline. One day is a signal, a cluster is a story. Continued draws or tight deliverable conditions confirm pressure. A persistent refill that calms, spreads weakens it. 5. Watch the street symptom layer, premiums, lead times, and the tone of procurement. You don't need perfect data, you need consistent direction. 6. Keep your 2-scenario lens loaded. If you get the controlled pullback and retest, you look for confirmation in behavior and structure, not just a green candle. If you get the continuation squeeze, you respect gap risk and avoid emotional leverage. And always define what would make you change your mind. Because that's the difference between conviction and stubbornness. And now the subtle part, the part that separates people who survive from people who become a cautionary tale. You don't need certainty to act intelligently, you need a framework. If the inventory draw is the first crack, you don't marry it. You monitor it. You understand what it implies if it continues. You understand what it implies if it reverses. You don't get hypnotized by a single dramatic number, and you also don't dismiss it just because it makes institutions uncomfortable. You treat it like a stress test result. And you ask the market to prove it in the places it can fake easily: behavior, structure, and repetition. That's where the real pressure starts, because repetition is what turns a headline into a regime. If you're the kind of investor who wants the truth, not the comfort story, you already know what this was. A signal that the market all is well. Narrative is at least incomplete. 3.1 million ounces disappearing overnight is not a guarantee of anything, but it is a message. And when you combine that message with a tape that's already volatile, a macro backdrop that's already unstable, and a market structure that can flip from calm to forced buying, when liquidity thins, you get a setup that deserves attention. Not panic, attention, discipline, and a plan for what comes next. So here's my final ask, and it's not begging it, it's an identity check. If you are here to be the kind of person who tracks structure instead of slogans, stay anchored to the checklist, compare the next week's behavior to the 2 scenarios, and don't let the market rent space in your head with cheap emotional tricks. Because the people who win in metals aren't the loudest. They're the steadiest. They watch the spreads, they watch the inventory behavior, they watch the curve, they respect volatility, and they wait for the moment when the market can't unsee what it just revealed.